Why are bonds collapsing and how you must protect yourself? Let's talk about it all. Hello everyone and welcome to my YouTube channel. It is a great pleasure to be with you. Please subscribe to this channel, leave a comment below, and please give a like to this video. It's very important. Bonds are collapsing, and the rationale behind this move is simply because there was too much optimism about the recovery in bonds. We need to take a few steps back to understand what has happened. In 2019, there were more than $19 trillion in negative yielding bonds. That is a good old bubble. Why was there such a massive amount of negative yielding bonds? Central banks were saying that there was no risk of inflation. Actually, that there was more risk of deflation. Everybody assumed that interest rates would be lower for longer. And at the same time, many banks and many investment banks had to take more sovereign bonds as collateral because the supply coming from governments was mostly taken by those central banks. Therefore, central banks were elevating the price of sovereign bonds to levels that were completely inconsistent with the volatility and with the reality of the issuer's ability to repay its debt. And at the same time, investment banks were getting more and more of those bonds to invest in so-called safe assets. So the price of sovereign bonds rose dramatically. Many believed that they would offset the negative yield with higher price. That is a good old bubble. And obviously, when central banks stopped purchasing those bonds, the collapse was immediate. Two things happened. One, first, inflation was not transitory. Inflation was persistent, and central banks had to increase rates at a very fast pace. Those two things led to a massive re-evaluation of the reality of the bond market. What happened simply was central banks stopped purchasing extremely expensive sovereign bonds and interest rates were rising. Therefore, there were massive losses in the portfolios of all of those investors and pension funds that had these negative yielding bonds. If we move further into 2022, what we saw was that with the collapse of bonds, we saw the collapse of equities. But in 2023, the message was that everything was over, that inflation was coming down, that the bond market was attractive, and that sovereign bonds were particularly attractive because they were low risk, but now they had a strong yield that was sufficient to compensate for inflation. What happened, obviously, was that in June, the reality was shown to everybody, and the view that inflation would come down dramatically between January and June of 2023 simply didn't happen. And what has happened in reality is that inflation remains persistent and that core inflation remains high. Central banks are not going to cut rates, therefore, they're going to keep rates. At the same time, the US economy is doing well. Job creation, GDP growth, yes, numerous challenges, very high level of debt, no discernible real wage growth, a collapse and decline in consumption and consumer confidence as well as in private investment. All of those things are warning signs ahead. But the Fed is not going to pay attention to any of those because job creation remains elevated and at the same time, inflation is also high. Therefore, there is a very low possibility of the Fed cutting rates. With the US bond yield reaching almost 5%, the 10-year bond, what ends up happening is that there is a massive move of capital going into the United States because it's a safer asset with a higher yield. And therefore, what was already a problem in many developed economies' central banks, because most central banks, let's remember, from the Fed to the ECB, are loss-making because they were purchasing extremely expensive sovereign bonds and mortgage-backed securities, and now the mark-to-market of the price of those bonds and securities relative to where they purchased are creating huge losses. Central banks in losses, persistent inflation, higher rates for longer means bond rout. Bond rout shows that the level of complacency in markets was extremely elevated and means that it's very likely that decline in the interest in demand for bonds all over the world is going to continue until the stock market crashes. However, the stock market doesn't seem to crash because central banks remain accommodative, and at the same time the economy is not doing badly. It's not doing well, but it's not doing badly. You see what I mean? And it's all about expectations. So the move of capital from bonds out of sovereign bonds is going to continue in this environment. Losses in pension funds are going to continue. So how do we protect ourselves? Because what this is probably is the beginning of a much larger issue. We have to therefore build positions in gold. We have to build positions in dollar assets, and more importantly, we have to forget about those allegedly safe bets in cheap European equities or cheap Japanese equities. Japanese equities are doing well, but let's remember, with the yen at 40-year lows, in dollar terms, they're not doing that massively well. They're doing okay. So the bond rout is very difficult to stop in an environment of persistent inflation and in an environment of rising US Treasury yield. Therefore, if we want to protect ourselves, what we need is real assets that will give us that cushion against a major change in markets. So there's no protection in European equities. There is no protection in sovereign bonds in Europe. So moving out of Europe and into the United States makes more sense, while at the same time getting as far away from emerging economies as possible is also an important factor, because the sudden stop that happens when flow of capital moves out of emerging economies and into the United States because the US 10-year yield is attractive is a very large problem. And what that creates in emerging economies is a double whammy, because they have fiscal and trade deficits in many cases, which means a higher level of demand for US dollars going forward. Higher demand for dollars, lower demand for euros, lower demand for yen, lower demand for emerging economies. A monetary phenomenon that will continue, currency debasement. And if you think that sovereign bonds are going to be attractive, think twice, because no government in any of these large economies wants to give money to investors, i.e., you are likely to suffer from financial repression both on the yield and now in the price. So there are opportunities in bonds, but they're not in the sovereign market. There are opportunities in equities, but they're not in Europe. There are opportunities in investment, but they're mostly in gold and in real decorrelated assets. Keep defending freedom. Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.